Have you been struggling with put options, getting assigned on stocks you don't want, getting assigned when you don't want to, and at a price that you're not comfortable with? Are you just overall struggling with put options? Well, this video is going to show you the reason why you're struggling, and I intend to show you how you can get better and why you're thinking about put options the wrong way and why you have it all backwards. So strap in, sit tight, don't skip any part of this video because I'm going to show you in depth what you've been doing wrong with put options and why you've been thinking about them the incorrect way all along. People would look at this and say, well, I want to buy the stock at 647, but I'm going to sell a put, so I'm going to sell it down here at 630, which doesn't really make sense because if you're willing to buy the stock now, why would you sell the put at 640 or 630? You're expecting it to go down, which is bearish. This is not bullish. And you might be saying, well, Corey, there might be a little bit of a pullback. Well, then wait for that pullback to buy the shares or sell the put even lower. If you're trying to sell the put now, but you're trying to sell it further out of the money, but yet you're okay with owning the shares right now, that makes no sense. So you have to look at the stock. Where is it likely to go? What is it doing? What does the news look like? And then pick a price that you're willing to pay for it. Then you sell the put option there. But you also don't want to miss the move. So for example, Meta is now partnering or trying to partner with Google and AI for their TPUs, which is huge. And if this goes through, it's obviously going to boost Meta even more. And they're completely undervalued right now. So the stock is really only going to go up at this point. I can't see how it's going to go down because it's already broke structure. So there's technical analysis here. We broke structure here, 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 more break of structure here, and more break of structure here. So we've already pulled all the way up. It could pull back down somewhere in this range in the coming week or two and then go this way. So selling put options down here would not make a whole lot of sense if you want the shares. It only makes sense if you're trying to get premium. Now, when the stock came all the way down, it got beat up. Hedge funds manipulated it, they beat it up, and they sent it down. The hedge fund strategy is they basically bought the shares from everybody on the way down, and when they did this, you guys were losing money as they're buying it from you, and you're in the red, and they're getting it cheaper and cheaper. It bottoms out here, and then what they do is they sell put options once the stock gets to the bottom. The reason they do this is because you as a retail trader are looking at the stock saying, wow, this could go even lower, so you end up buying put options here, but they're smart. They sell put options. They sell some put options at 580, 590, 600, even some at 615, 620, and the stock goes up. All these put options become worthless. So you lose money on the way down, and then when it's going back up, you're losing money in the puts. This is what they're doing. This is one strategy with puts, is to be bullish on a stock. So for example, when Meta was 586, I sold put options at 600, which would have been right up here where this orange line is. I sold puts here when the stock was here. Stock runs. These put options are like 80% positive. I bought to close them and made good money on them. You have to understand that put options could be bullish, bearish, or neutral. We're going to go over those three strategies right now, and I'm going to show you how to utilize put options to generate safe passive income and get stocks at the price that you choose, but how you can also make a lot of money on put options because they're safer. So let's go over put options and why they're safer. If you have somebody buying a leap option on Meta, let's say they're buying a 650 or 700 call on Meta when the strike. So let's go look at a different stock. So let's look at Palantir. Let's say you are looking to get into Palantir right now at the current price of 168 and someone else is looking to get in at the same time. So person A buys a call option for 150, okay? 150 on Palantir is very likely to be a delta of roughly maybe 60. But let's go look at the chart. We're going to look at Palantir and we're going to see a leap option on calls going out to June of 18. And we're going to do a 150 and this is going to be a 70 delta. Okay, 70 delta. If the stock was to go to 200, okay, because right now it's 168. So going to 200 would be a $32 move. $32 move up here to 200, okay? So what would you make on one call option? Well, if you were to do a call option and it was to run $32, you would take $32 off of the 150. So we're looking at the 150 call, but because the stock went up $32, we're going to see what the call option would be for 120. That's a $30 drop. And 120 is worth $58.70. $5,900 was the last sale. So $5,900 off of $3,900. You would make $2,000 off that run. Okay? Bear with me here. I'm showing you the difference between a leap option and a put option. So a leap option, you're going to make about 2K off of this move. 77 delta. Now here comes the tricky part. Instead, I would sell a 99 put option, a 99 delta put option. That's what I would do. So let's see what that does. We go over to puts, and I would sell a June put option. That's 99 delta. And this would be roughly a 350 put. Okay. We probably would go with there was more open interest because 10 delta is not going to change drastically, but we want to be. So there's not a lot of volume and open interest here. We're just going to go with it just to show you what actually happens. If I was to sell this 350 put, I would collect $18,000, $181. Okay. Now, if the stock was to go up $32, then obviously that would be added to the put option, just like we deducted it from the call option. So whatever the 380 is worth is what my 350 would be worth. So 350, we add 30 to 380, it's worth 211. So $211.98, which is $21,198. Okay. We can see that right here. And the reason we're doing this is because if the stock goes up $30, then we want to see what the current price is right now for a put that's $30 deeper in the money, because that's what our put roughly will be worth. So 21,198 minus our original put of 18,198. We make 3,000. Okay, so we are going to make $3,000 more by selling a 99 delta put than buying a leap option. Now, let me break this down for you why this is so important. We know the stock is bullish. We know the stock is going to go up, right? So you can make 2K on the call option, or you can sell a 350 put and make 3K. Now, what is the reason for doing that? Well, I'll tell you. Let's say the stock comes up and then it drops down to like 149 and sits down here for 3 months. The call option buyer is going to lose 50% of the call's value. And if the stock doesn't recover in time by June, it expires worthless or at a loss, and he can never recoup his money back. It's gone forever. If you sell the put option at 350, you immediately collect 18,198. Okay. So we take 350 put minus, okay, which is 181.98. Your average price is 168, which is exactly the current price. So you're getting in at the current price no matter what right now. If it drops to 149, the person who bought the leap option, the call option, is permanently losing money if the stock doesn't recover, or it'll expire worthless and they lose all of their money, which is $3,900. However, with the put option being so deep in the money at $350, you'll likely be assigned within the first few days of selling it almost immediately and have the shares. And sometimes you won't, but a lot of the times you will. The stock will then sit down here for a couple of weeks, but you have the shares, they don't expire. And when the stock recovers, let's say it recovers in August. Well, guess what? The call option expired worthless, and now you make thousands and thousands of dollars. So if you think a stock is going to run, you make more money on the put. And then if the stock drops, your protection is worst case, you get the shares and you're in the red. For the call option, it expires worthless, you lose all your money. This is how you utilize a bullish strategy on a put option. Most traders, most investors, most YouTube channels don't even explain this. This is actually a trade that we did in Discord. We sold 577 puts on Adobe when the stock was 331, and 3 days later it ran to 363, and we got out at 3,000 profit per put option because we were bullish on the stock. If you expect a stock to go up and you expect that stock to go up quickly, selling put options up here makes more sense, especially if they're deep in the money. So we now understand a bullish strategy on put options. But let's also talk about why selling put options multiple weeks out in a bullish fashion is better than just 1 week out. If, let's say, you have two people, person number one is selling a put option 1 week out, and they're going to sell it on Palantir, puts 1 week out, and let's say they're going to sell a 160 1 week out. They're going to collect $130, okay? 130. 1 week equals 130, and this is going to be for the 160 put. This is person number one. Person number two is going to sell the 160 put, but they're going to sell it 3 weeks out. We go over here, we go 3 weeks out, and this individual is going to make $528. Now, you might be asking yourself, why would they do this? Well, if the stock goes up in the first week, this put is going to be good. It's going to be worthless. Free premium, right? Free premium. However, they only made 130. So now this person has to sell a 175. The stock goes up in week number 2. Now this person's got to sell 184. The stock drops and it's a complete loss. This is what you're doing. It's called chasing. With scenario number 2 or person number 2, by selling 3 weeks out, you collect all this premium up front. So when the stock starts running in the first and second week, you buy it back at like 80%. And then the stock drops, but you're no longer in because you collected it all up front. Instead of chasing little by little, you just sold a put option further out in time, and it helps you make money, a lot more money and a lot quicker. And this is a good strategy because essentially what you're doing is collecting it all up front because your confluence is strong that you know the stock is going to run. A better way to even do this is to sell a 170. We look at the stock and we see that it's likely to come back up into this range, 177. So we sell a 175 put. So we do a 175 put. And for 3 weeks out, this put option is going to be $1,225. Now, we'll probably not see all of that because we'll buy it back at a profit. But if the stock goes up $7 or $8, well, then that's the equivalent of dropping this $7 or $8. So if we do that, 165-ish, it'll be worth $700. So if the stock goes up $7, $8, we'll be immediately in a 50% gain the first few days, which is way more than the 130. We could make quadruple the money in the same amount of time or even faster because we're bullish that this stock is going to move. So selling put options down here makes literally 0 cents. You're thinking about buying the stock at 168, but for whatever reason, you've said, okay, I want the stock at 168, so I'll go ahead and sell a put option to collect premium, which is the right choice. Step number 1, premium on a put option, but you're selling down here. Why are you selling down there? Well, we think the stock's going to drop. Okay, well then wait for the stock to drop. You just thought it was okay to buy here, so why would you sell the put option here? I know you want protection, but essentially a put option is a way of getting stock cheaper. If the stock is 168 and you go a week out and you're selling, let's say at 167.50, you're getting 575. So you're selling a put option right here and collecting $500, which is $5. So your average is actually 162, which is $6 lower than the current price. This is perfect. This is an at the money put. This is a good way to actually get assigned because you're trying to get assigned. That's the whole point. You want to be assigned because if the stock drops a little bit, you get assigned and then it runs all profits right here. What you don't want to do is get into a very vicious circle of selling put options way down here and the stock does this number and then runs and you miss the whole move and all you get is $100 for 1 week. This is why you're having trouble because then you sell a put here, 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 and the stock tanks and you're getting assigned. So what are you doing? You're trying to roll your put out and that's not good. So let's talk about why rolling your put out is not a good idea. So this is something I also teach in Discord. Rolling put options, not the greatest idea all the time because if you're chasing in this scenario and the stock drops and your put option that you sold was right here, you are now $15 in the money. What you're going to do is roll out 3 weeks to a month and down to 172. And you're only going to collect $10 or $20 or $30 for a whole month. And you're going to do this month after month after month after month. And it's going to take you 6 months to make $200 or $300. And then the stock flies and you miss the move. You seem to forget or not understand the idea of the put option. The put option is not a little bit of premium. That's just the icing on top. And the icing on top is good, or the cherry and whipped cream on top, so to speak. However, the idea of the put option is to get the stock so that you can take the flight with the stock and make the money. So essentially, selling these put options like this all the way up and the stock drops, take the assignment, sell more puts down here or right at the money or even in the money right here. And when the stock runs, you take the shares with you. It's not a good idea to chase puts up and when the stock drops, roll out because you're wasting so much time. If you have $50,000 in put options for Palantir and you're rolling them out every month, you're probably going to make less than $1,000 or $1,500 over the course of 3 or 4 or 5 months. And then when you miss the move, you've wasted half a year for $1,500. $50,000 in a half a year should generate $3,000 or $4,000 or $5,000 or more, probably a lot more than that, definitely a lot more than 1,500. So you're losing time, losing money, and psyching yourself out is the incorrect way to operate when you're selling put options. Put options are a great way to take entry on a stock you want at a strike price you want on your terms and collect premium while doing it. And the benefit, the benefactor, here it is, the benefactor put options is if you are not assigned, then the premium is free and it adds up. So you could sell a put option on Palantir. Here, the stock runs, you sell it here and it runs, you sell it here, it drops, and you get assigned when the stock's at 180 and you get assigned at 180, 250. So you're out 250, but you collected 500, 500, 500, which is basically $1,500, which is $15. So even though you got assigned at 182 and the stock is 180, average is actually around 167. So you're still roughly $1,300, $1,200 in the positive. This is how you make money. Let me show you on SoFi. Same thing on SoFi. If you sell a put option, stock's $29.72, you think it's going to go up. So we're going to sell a put at $30 1 week out. Okay. Puts 1 week out. We're going to sell a 30, which is a 53 delta. It's $100 per put. Okay. We're going to sell 10 of those. Next week, the stock runs up to 30.50 or 30.70. We go another week out and we do another 10, collect another $100. Stock runs, it's $31. And then we go out another week and sell another 10 puts at 33. And the stock comes up to 33 and then drops to 31.70 or 31.30 down here. And we take the assignment at 33 on the third week. Okay. This is 1,000, another 1K, and another 1K because we're selling 10. They're $100 each because they're 53 delta. They're bullish. We're bullish on the stock. We make them more money. That's how it works. We make them more money. And that is the point of the stock market. All right. So we made $3,000 divided by 10, which is $3. $3 per put option per share. So when the stock actually drops down here to 31.30 and we got assigned at 33, we have to take the $3 off. So our average cost is 27. Okay. Now I'll break this down for you individually. So let's break this down. Okay. So what we're going to do is we sold 10 put options at $100, which is $1,000 per week times 3 weeks, which is $3,000. Divide this by 10 put options. We averaged $300 per put divided by 100 shares, which is $3 per put option. Okay. We're getting assigned at 33, which means our break even is 30. Because remember, we got assigned at 33. The stock dropped to 31.30. So let's break that down. 33 minus 3 equals 30. Average price now is 30 and the stock is 31.30, 31. So we're still up $1. We're in the green and we have the shares. Now, let's say what happens next is the stock runs. You see, we didn't miss the move. We took the assignment right there. The stock dropped, but we've already made $3 per share and the stock's 31. So we're still $1,000 in the green. For 1,000 shares. $1 times 1,000, $1,000. But now the stock runs and it runs to, let's say, 36. So now we just made $6,000 on the shares, 5,000 more than when it was 31, 5K more. Anyone who avoided this scenario and rolled out and down to 29 missed the move. See, down here, they would have missed the move. We literally took this assignment. The stock dropped. We took it and then it ran and we got to make the money on it. Or instead of exiting when it gets up to 36, we run the wheel strategy, which if you want to see a wheel strategy video on how to make lots of money and passive income running a safe wheel strategy, comment below. If you want to see that video, I'll show you what I'm teaching my students in Discord on how to execute the wheel strategy properly. Once you get to $36, $35, $34, wherever the stock goes, you start selling call options up here and you don't care if you get assigned. The stock comes up, bounces back and keeps doing this number. You just keep selling call options, $1,000 per week, selling them at 36, at the money, 50 delta because you're trying to exit. This could turn out to be $10,000, $15,000 in profits over the course of a few months. This is how you make safe passive income and how you utilize put options the correct way. Now, utilizing put options in a bearish scenario, if you're bearish on SoFi and you say, look, I think this stock is likely to go back to 27. I want to buy it at 27 and start collecting premium now. Then you would set your put options out 2 to 3 weeks, maybe a month at 27 and let it rip. And you would just set it right here at 27. We're going to go into SoFi. We'll go out to December 26th, maybe January 2nd. And we will sell $27 puts for $100 each. And we will sell 10 of those. 10 times 100, another $1,000, which is $1 per share. So our average is going to be 26. So as long as the stock stays above this orange line right here, which we're actually going to make red, and this is what I do on my put options. There we go. As long as the stock stays above this line anywhere, we are in the green. And if the stock was to drop to 24 or 25, we're only out $1. What you do in this scenario is you wait for stabilization on the stock. You look at previous support levels, and we could see that support levels show it could come down to 22 or even 21. We wait. And if the stock does this number and then comes back up and breaks the structure and starts support here, we would then sell put options at 24. We'd sell them at 23 and we'd sell a couple more. So when the stock runs, this is free money. If this stock doesn't run and it drops into this range, well, we got assigned here. And if the stock does drop down here, well, then we got assigned at number 1. And number 2, which means our average is now here at number 3. So when the stock does run, our average is now down here because we utilized dollar cost averaging with the put options, utilizing some bearish puts with some at the money puts, maybe even some in the money bullish puts because we're bullish on the stock moving up. So I'm going to show you a full-fledged scenario on how I would personally trade SoFi right now. I would actually sell a couple of $30 puts going a few months out. I would also sell a couple of $27 puts going a month out. And then if the stock starts to move upwards like this, I would buy to close these. I would close them out. And then I would roll this put out and up, or I would hold it closer to expiration to make more money to see what happens. If the stock was to drop after I opened these two puts like this, well, then what I would most likely do at this point in time is I would roll this put out another month and down to maybe 29 or 28 and take the assignment at 29 or 28. And this one right here, I would leave it for assignment, wait for the stock to settle. I would take both these assignments and then I would sell a put option here and then a couple more put options here. Because by doing this, you have one up here, one down here, one here. So the average cost is going to be somewhere around 27, and that's where the current price is. By utilizing lower puts down here and higher puts, you don't miss the move because you're going to get some of the shares and you're going to average your cost in the middle somewhere, and you're using technical analysis to find the right strike price. The way you were doing it before, most likely, is you were just selling puts way down here. Now let's step into the most advanced part and explaining why selling way out of the money like this is actually bad. Selling too safe, too far out of the money has extreme consequences. Let's talk about that. So when you sell far out of the money, you're basically saying, I'm only willing to buy the stock if it tanks. But then when it tanks, if it does, you're trying to dip, bob, and weave, run away from the assignment. This is why you're losing money on put options. Because when you sell a put option way down here, the only way that's going to come down, that stock's going to come down and get you assigned, is if it tanks. This is so far out of the money. In this scenario, the only way that's going to happen is if this happens. And what are you going to do in this scenario? You're going to try to exit or roll out and down, wasting time, wasting money, dipping and weaving and bobbing and trying to avoid the assignment, right? And then guess what happens 6 months later, 3 months later? It runs and all your gains are gone. You either break even, lose a little bit, or hardly make any money at all. This is the problem. When you sell extremely low delta puts, they're not safe. They're safe for the time being. You might sell a put on SoFi, let's say, going out a month at $24, or let's say 22. This is an 8 delta. You're going to make $24 a month, right? Times 6 months, $144. And then on your 7th month, the stock drops all the way down to $19. And when it does this, you lose $300. So 6 months work and you're still $150 in the red. You're $3 below your strike price. The stock is now dropped to 20 from 22. So you're out actually $2, which is $200, and all you made was $144. Meaning you lose $56 after 7 months because you're likely going to roll out and down, or you're going to buy to close at a loss, and you're going to dip, bob, weave, and run and sprint away from this assignment because it's a tanking stock and you no longer want it. So selling put options this far out of the money doesn't make any sense ever. You're going to wait for this to happen, then sell your puts right here at 20 if you want to be safe, which I wouldn't do. I'd wait for this to happen, and then I would immediately sell in the money puts at 23 or 22, 3 months out, knowing the stock will recover and eventually come back up, and I'll collect all that massive premium at 99 delta. This is what's so powerful about this strategy. If the stock, and you say, Corey, well, the stock's not good, well, then you shouldn't be selling put options on it at all. If it ain't a good stock and it doesn't have good technicals and fundamentals, you don't understand the balance sheet, don't sell puts at all. Once we've established a good stock, which if you want to see a video on picking good stocks and valuations and understanding that technical analysis, leave a comment below and I'll teach you guys that and the wheel strategy as well. So when we look at these put options, we've now picked a good stock. We've already done that technical analysis. We understand the stock is good. You either wait for the stock to drop if you think it's going to happen, then you sell put options, or you sell them closer to the money, at the money, or even in the money, especially if you feel like it's bullish. This is why you're having trouble. Selling put options this far out of the money is not safe because over time you make very little money. And then when the stock does dip down here to assign you, you run from it because the stock is tanking and it scares you away, which is psychology, which is something I also teach in Discord. This is why you're doing put options wrong. If you want to see another video on put options with more in-depth examples, leave a comment below. If you also want to see the understanding fundamentals and analysis and the technicals and understanding the balance sheets and how to valuize a company, or you want to see the wheel strategy or all of the above, comment below. If you guys want to learn more of these strategies and learn how to turn your account over and over into profits every single week, month, and year, like my students are making profits right there, I would love to help you in the Discord. This is just scratching the surface on what I teach in Discord and why my students and I are making so much money. You can sign up. The link is in the information box below. I look forward to seeing you in the next video and in the Discord real soon. One love, fam.